One of the most common questions in crypto is when to buy. Should you wait for a crash? Try to time the bottom? Go all in when you think it's cheap? For most people, the answer is dollar cost averaging, or DCA. This strategy involves buying fixed amounts at regular intervals regardless of price. In this video, I'll explain exactly what dollar cost averaging is, why it's popular for crypto investing, the psychology behind why it works, how to implement it, the pros and cons, and whether it's actually the best strategy for building crypto wealth. Let's dive in. Dollar cost averaging means investing a fixed dollar amount on a regular schedule. Instead of investing $10,000 all at once, you invest $500 every 2 weeks for 40 weeks, or $100 every week for 100 weeks. The amount and frequency don't matter. What matters is consistency and ignoring price. You buy whether Bitcoin is at 30,000 or 60,000. You buy during bull markets and bear markets. You buy when everyone is euphoric and when everyone is panicking. The strategy originated in traditional stock market investing. Financial advisors recommend DCA for retirement accounts. You contribute a percentage of each paycheck to your pension or retirement account, regardless of whether stocks are up or down. Over decades, this builds wealth through consistent accumulation and compound returns. The same principle applies to crypto, though crypto's extreme volatility creates both bigger opportunities and bigger risks with DCA. Let's look at a concrete example. Imagine you started dollar cost averaging $100 per week into Bitcoin on January 1st, 2020. Every Monday for the past 6 years, you bought $100 of Bitcoin regardless of price. Some weeks you bought at $4,000 per Bitcoin, some weeks at $60,000, most weeks somewhere in between. Your average purchase price would be much better than if you tried to time the market and likely bought near peaks out of FOMO. The mathematics of DCA work in your favor during volatility. When prices are low, your fixed dollar amount buys more Bitcoin. When prices are high, it buys less. This automatically gives you more exposure during dips and less during peaks. You're mechanically buying more when it's cheap and less when it's expensive. This is the opposite of what most people do emotionally, which is buying a lot when prices are rising out of excitement and buying nothing or selling when prices crash out of fear. The psychological benefits of DCA are often more important than the mathematical ones. Trying to time the market creates enormous stress. Should you buy now or wait? What if it drops after you buy? What if it moons and you missed it? These questions create analysis paralysis. Many people wait for the perfect entry, which never comes, and miss the entire bull run. Or they buy at the worst possible time during peak hype. DCA removes this psychological burden. You don't need to predict anything. You don't need to watch charts constantly. You don't need to feel smart or lucky. You just execute your plan mechanically. Buy your fixed amount on your fixed schedule. This consistency is powerful. It keeps you invested during bear markets when most people give up. It prevents you from going all in at tops. It enforces discipline. DCA also smooths out volatility's emotional impact. When you buy all at once and price immediately drops 50%, it's devastating. You feel stupid. You panic. You might sell at a loss. When your dollar cost averaging and price drops 50%, your next purchase is exciting because you're buying at better prices. The same drop that crushes lump sum investors benefits DCA investors. This emotional difference keeps people in the game long enough to see returns. However, DCA isn't perfect and has clear disadvantages. The biggest is opportunity cost during bull markets. If you have $10,000 and Bitcoin is at $20,000, going all in means you buy half a Bitcoin. If Bitcoin goes to $100,000, you made $80,000. If you DCA that $10,000 over a year and Bitcoin rises steadily, you buy at increasingly higher prices. Your returns are lower than if you invested everything at the start. Mathematically, lump sum investing beats DCA in rising markets. If you're confident an asset will increase in value, investing all available capital immediately maximizes returns. Studies on stock market data show lump sum investing outperforms DCA roughly 2/3 of the time because markets generally trend upward over long periods. The same principle applies to crypto during bull markets. But here's the problem. You don't know if we're starting a bull market or about to crash. Crypto has experienced multiple 80% crashes. If you lump sum invest right before a crash, you suffer massive losses and might not recover psychologically. DCA protects against this worst-case scenario. It's risk management, not return maximization. You accept slightly lower potential returns in exchange for much lower risk of catastrophic losses from bad timing. The ideal DCA strategy depends on your situation. If you receive regular income and invest a portion of each paycheck, DCA happens automatically. This is the best approach for most people. You're not choosing DCA over lump sum. You're investing as money becomes available. If you have a lump sum, say a bonus or inheritance, the decision is harder. You could DCA it over several months to reduce timing risk, or invest it all immediately if you're confident in long-term prospects. A hybrid approach makes sense for many people. If you have $10,000, you might invest half immediately and DCA the other half over 6 months. This balances immediate exposure with protection against buying right before a crash. You participate in bull markets while managing downside risk. There's no perfect answer. It depends on your risk tolerance, time horizon, and conviction. Frequency and amount matter less than consistency. Some people DCA daily, others weekly, bi-weekly, or monthly. Daily DCA reduces timing risk slightly more, but creates more transactions and potential fees. Weekly or bi-weekly aligns with most people's income schedule. Monthly is simpler, but means 12 purchases per year instead of 52. Choose a frequency you can maintain forever. The amount should be sustainable long-term. Don't DCA $500 weekly if you can only maintain it for 3 months before running out of money. Better to DCA $100 weekly for years? Crypto is a long-term game. Consistency over time matters more than individual purchase size. Automation is crucial for successful DCA. Manual execution fails because life gets busy, you forget purchases, or you skip weeks because of fear or greed. Set up automatic purchases through exchanges that support recurring buys. Coinbase, Kraken, and many exchanges offer this feature. Connect your bank account, set your amount and frequency, and let it run. Automating removes the temptation to override your plan based on emotions. DCA works across different crypto investment approaches. You can DCA into just Bitcoin for maximum simplicity and lowest risk. You can DCA into a portfolio split between Bitcoin, Ethereum, and a few other projects you believe in. Some people DCA into index-like allocations across the top 10 or 20 cryptocurrencies. The strategy works regardless of what you're buying, though concentration in Bitcoin and Ethereum is generally safer for beginners. Bear markets are when DCA proves its value. When Bitcoin crashed from 60,000 to 16,000 in 2022, most investors stopped buying or sold at losses. People who maintained DCA through the entire bear market accumulated Bitcoin at incredible prices. When the next bull market came, those consistent buyers reaped enormous rewards. Bear markets feel terrible while happening, but they're when DCA builds the foundation for future wealth. The hardest part of DCA isn't the strategy itself, but maintaining conviction during prolonged downturns. When Bitcoin is down 80% and media declares crypto dead, continuing to buy every week takes courage. This is why having a long-term thesis matters. If you only buy crypto for quick profits, you'll quit during bear markets. If you genuinely believe in Bitcoin's long-term value proposition, buying during crashes makes logical sense even when it feels scary. Tax implications of DCA create complexity. Each purchase is a separate tax lot. When you eventually sell, tracking cost basis across hundreds of purchases becomes annoying. Use exchanges that provide tax reports or dedicated crypto tax software like Coinly or CoinTracker. The tax complexity is a downside, but manageable with proper tools. DCA doesn't guarantee profits. If you DCA into a cryptocurrency that goes to zero, you lose money. If you DCA into a project that gets surpassed by competitors and never recovers, you underperform. DCA is a purchase strategy, not a guarantee. You still need to choose quality assets. DCA into Bitcoin is much safer than DCA into random altcoins. My honest take is that dollar cost averaging is the best strategy for most people investing in crypto. It removes the impossible task of timing markets. It enforces discipline during both euphoria and panic. It smooths emotional volatility and keeps you invested long-term. Yes, lump sum investing might outperform during bull markets, but most people lack the conviction to go all in at the right moments and the psychological fortitude to hold through crashes. DCA gives you a fighting chance by making good behavior automatic. For building crypto wealth over years, DCA combined with long-term holding and focus on quality assets like Bitcoin and Ethereum is hard to beat. If you found this strategy breakdown helpful, make sure to subscribe for more crypto education. We've covered everything from Bitcoin basics to DeFi to investment strategies across these videos. In the next video, I'll explore what exists beyond Bitcoin and Ethereum and introduce you to the wider crypto ecosystem. Thanks for watching, and I'll see you in the next one.